This is going to be, we'll talk about Chapter 3 for a little while. I'm actually on the plant floor today. I borrowed somebody's office to make the video. You'll see people behind me consistently, so apologize if they're a distraction for it. Let's talk about accrual basis accounting first. With accrual basis accounting, it's really about matching revenue and expenses when they're incurred. Now, before accrual, we're talking about 50, 60 years ago, the focus was on cash basis of accounting. With cash basis of accounting, what that meant was that all we would do is when we received cash, we could record revenue. When I paid out cash, I could record expense. Everything was solely about cash. There was no leeway. Cash in, revenue; cash out, expense. But over time we realized that's really not the best way to do things, because you have jobs and you get those complete. And as you do those, you really should be able to record the revenue in the period that you've actually performed the work, and on the same side with expense. If you've incurred an expense, and you're going to pay it, expense is just an obligation, right? That's what it really is. We're going to have to pay it. So we do our best to match the revenue and expense in the period that they're incurred. So if I incur $100,000 to get a job done for revenue that's going to bring me in $500,000, I want to record the $500,000 in the same period I do the 100, right? Because those two are going to really net out against each other. So that's really the core of accrual-based accounting, is that we want to do a good job of matching revenue and expenses. We talk about revenue. The book does a great job on page 95. It says, recognize revenue in the accounting and period in which performed obligation is satisfied. Basically saying the job is complete. Now, since this is chapter 3 in the book, and we'll get into it a little more complicated in future chapters, we're going to have a quick second talk about Incoterms, I-N-C-O, Incoterms. I'm not sure which chapter that is, and I'll just kind of jump ahead a little bit, probably to the later chapter. It may not even be in your book, but you'll see it if you go into intermediate accounting and stuff like that. Incoterms really determines when title passes to a good. When title passes from you, the provider, right, you're the vendor, to a customer. And you'll see a whole bunch of those. FOB destination. FOB is freight on board, destination. So the title will pass when it reaches its destination. So what that means is that I, the vendor, will maintain title to the good until it hits this destination point. At that point in time, it now becomes the responsibility of the customer. So as soon as it hits this destination point, like FOB destination, hold on. So with revenue recognition, what we're talking about is really matching those things back to Incoterms. What we have on the Incoterms is that FOB destination, free on board, freight on board, it could be either one depending upon which book you're looking at. Destination, I maintain title till it hits this destination point. At that point in time, the customer receives title. As soon as it hits this destination point, I'm able to record revenue, because what I have done, I have performed the service for created the goods and delivered them to the agreed upon point. Now, what that does mean is that once it's this point, I can record revenue. Perfect theory, according to generally accepted accounting principles, I should not record revenue until it hits this FOB destination point. I shouldn't record revenue up until that point. As soon as I hit the destination, then I can record it. Now, there's a whole bunch of those things. There's CIP, there's CIF, cartage, insurance, and freight. When you see CIF, what that really means is going to be I pay everything. I pay the insurance. I pay the freight, all the way up to a certain point. FOB destination is really the one which you see most often. I mean, there's like a crazy number of those things. But keep in mind, right? When you talk about FOB, it doesn't have to be destination. It could be FOB my facility. And so what that means, FOB my facility, all that means is that as soon as it hits my dock, right? At that point in time, the title passes over to the customer, and I can record revenue as soon as it hits my dock. Those are the ones that we prefer to have. We don't really see a lot of those, unfortunately. It's usually FOB destination. It could be FOB customer's dock. Of course, what that means is, just as soon as I provide it, I get it over to it, I ship it, I put it on a truck or boat. As soon as it hits the customer's dock, at that point, change title. The reason why we care about title changing is that, assuming there's a problem in transit. So let's pretend we put it on a tractor and trailer, the tractor and trailer flips over and it breaks. Right? We lose everything. So if I maintain title to it, then what I'll do is I will be able to file a freight claim against a carrier to be able to recoup my cost, the value of that good, not the sales price, just the cost of it. So the way it works, I've tried doing the sales price multiple times and I always get shot down, but it's the cost. It's my cost of material, labor, overhead, anything in my cost of it. On the flip side of it, if we hit a point, we call it FOB my warehouse, and FOB my warehouse, right? It's the customer's responsibility. They pass title to it. Something happens on their end, flips over. It doesn't bother me at all, right? The customer will then go through, file a freight claim for their cost, right? Their sales price of those goods, and they'll come right back to me and say, Michael, I want you to remake these goods for us. Awesome, cool. Double the revenue. Kind of jumping ahead, probably maybe to intermediate or at least later inside your book. Anyway, sorry, back to work. Expenses in a similar capacity, right? We incur expenses when they're incurred. So if I go through and I have a marketing expense in the current period, but I don't pay it, right? Pretend I don't even receive my invoice. I will record that as an expense in the current period, right? And that's really all accrual is about. It's like, I may not have the invoice. I know I incurred the cost. So what I'm going to do is I'm going to book a journal entry. I'm going to record that inside my financials. So my monthly financials is honest, as accurate as they possibly can ever be. That's what it is. So for example, I'll give you the one we just had. Let's pretend I had a marketing invoice for $500. I should say a marketing expense for $500. I didn't receive the invoice. I know I incurred it though. So what I'm going to do during the month that's incurred in, I'm just going to book a journal entry. I'm going to debit marketing expense, and I'm going to credit a liability account, some type of other payables or some variation of that, right? Because what will happen is that I'm pushing the expense in the current period. Next month, as soon as I receive the funds in, the invoice in, I'm going to flip that entry that I just made. And between the two, they're going to net out, right? I'll have the expense in the current period over the others. It'll net out to be nothing. It's really cool. Pay special attention to the first part of your book. It's all about entries. We want our financial statements to be as accurate and truthful and clear as possible. If we have an expense during a period, we want to fully burden that month. We want to fully burden that period because we want to have our financials accurate as we can, because we want our revenue and expense to hit in the same period. It's really do, right? It's all about matching. Now, when you start on page 98, we're really going to talk more about these prepaid expenses. Inside of that, when we talk about prepaids mean that we're going to go ahead and pay this stuff ahead of time. So, for example, rent is usually one of the big things. When you're a small company, you're going to want to get a storefront. You're going to go to a storefront, you're going to say, hey, I love this place, I want to buy it. And they're going to say, look, okay, fine, the rent's $1,000 a month, but we require you to pay 6 months in advance. Okay, so what that's going to mean is I'm going to give the landlord $6,000. It'll be a debit to prepaid rent, credit to cash. Because as soon as we hand the cash over to the landlord, we'll pretend it's on December the 1st. On December the 1st, as soon as we pass that over, what we're going to find is that it's still an asset, right? All I've done is I've converted an asset from cash into a prepaid. So that's totally fine and dandy. As we live there, at that point in time, we're going to record an expense. So on December 1st, $1,000 a month rent, 6 months, it's going to be a debit to prepaid rent, credit to cash for $6,000. Every month that we live there, every 30 days or 31 days, every month we live there, I'm eating up 1 month of that 6 months I prepaid. I'm eating up 1 month of that 6 months I prepaid. So what I'm going to do is I'm going to debit my rent expense and credit prepaid rent for $1,000. Well, I had 6 months. I've just lived there 1 month. That means I can still only live there for 5 months. So my prepaid asset, this prepaid rent, has went down $1,000. So when it was 6 before, the landlord $6,000. I've used up 1 month of it because I've lived there. That means I've got 5 months left over. So time passes. Now January 31st, same entry. It'll be a debit to rent expense, credit prepaid rent for $1,000. Now I can only live there 4 months without paying any additional cash. Time passes. February 28th, same entry. Debit rent expense, credit prepaid rent, $1,000. Now I can only live there for 3 months without paying cash. What we're doing, we're effectively eating that up, right? Every month passes, I'm eating up part of this prepaid. The reason is that we just aren't. Yeah, we're just doing a good job of matching the revenue and the expenses, especially expenses, in the period that they're incurred. Same concept, exactly the same as prepaid insurance. Now, the reason why we have a lot of prepaid rent is most storefronts, since there's such volatility in companies coming and going, that's why the store owner, right, the landlord, will require you to pay 6 months. I mean, that way, if your business folds within 2 months, he still has 4 months, and you don't get the money back. You still have 4 months to have that facility yours, right? He's been paid. Your facility, your business closes, stinks, goes away. He still has your rent for 4 months, and that time he can find another he can find another person to come in and take that storefront away for you. That way, he's not really out any money. Similar concept on prepaid insurance, exactly the same. Your book does a great job on talking about supplies. So we'll just talk about one very quick and easy. Let's pretend I had a balance. If I had supplies of $1,000, I bought $500. So at that point, I got $1,500 supplies. Let's pretend we wait till the end of the month. We do a full count of what I have there, and I have $200 left over. How much supplies did I use up? Well, it's going to be $1,300, right? Because I had 1,000 plus purchases was 500. That moves me down to 1,500. Okay, time passes, right? I use it up. People steal it. Whatever happens to it, right? I've got $200 left over. I do a count of my supplies. $200 left over. That means I basically have $1,300 used up. So my journal entry would be a debit to supplies expense, credit to supplies. Because what I'm doing, I'm recording the expense, right? We record the expenses basically as I use it. During the month, I use up $1,300 supplies. What do I have to do? I have to pull my supplies down by $1,300 as well. Depreciation is great. What we're going to do in Chapter 3, we're going to talk about straight line. There's many ways to handle depreciation. We're only going to care about one right now. We're going to talk about straight line depreciation. Straight line is a simple formula. It's parentheses up top, base minus salvage value, divided by the number of years of life. The base is the purchase price plus all costs necessary to have the asset up and running. So, for example, if I had my asset cost me $5,000, I had $300 in freight, my base will be $5,300. It is my base is my purchase price plus all costs necessary to have this asset up and running. Salvage value is the value at the end of its life. And I'll define its life. I could have the life of being 5 years or 3 years or 20 years. So I'll end up determining that. Now, in reality, what I'll do is I'll work with salespeople, who actually sold me the equipment and say, look, how much is it going to be worth after 5 years? And because they're the experts in that, they can say, well, hey, it's going to be worth $500, whatever it is. They'll give me that number. We go to experts. We don't simply make it up. We go to experts, the folks who will know. They give me that number. So it's base minus salvage value in parentheses divided by the years of life. And that's the other part, right? I just mentioned I create the years of life. So the years of life and the salvage value will go hand in hand, but keep the value is something I'll get from the salespeople. Okay? My journal entry to record depreciation is a debit to depreciation, a credit to accumulated depreciation. Accumulated depreciation is a contra asset. So what that means, it's going to be under the assets section. But whereas most assets have a debit balance, a contra asset will maintain a credit balance. So the contra asset acts to reduce your debit balance of equipment. So same exercise. If I had $100,000 of equipment, it'll be on the debit side, $100,000 debit side. I've got $5,000 of contra asset for the accumulated depreciation of $5,000. I'm going to net those two out. So it'll be the $100,000 of equipment less accumulated depreciation of $500 give me my total asset, my total equipment of $9,500. Keep in mind that depreciation expense is a non-cash outflow. non-cash, right? So you think about labor expense and payroll and utilities and everything else, all those wonderful things there, I have to pay cash. But when it comes to depreciation expense, I'm not paying cash for that. It's a paper expense. That's all it is. It's an expense on paper only. It acts to reduce my income from operation, but it's not a true cash outflow. So in future chapters, when we prepare a statement of cash flow, what we're going to end up having is, well, we'll be adding that back, but let's not worry about that yet. Depreciation expense is just a non-cash outflow. Unearned revenue. Unearned revenue occurs when somebody pays me ahead of time and I've not yet performed the job. So what that means, they give me cash. Let's say they give me $5,000. I will have a debit to cash, credit unearned revenue of $5,000. Unearned revenue is a liability. It's a liability because what that means, I either have to perform the service or give them their money back. So your book does a really good job on that too. Okay. That goes through your notes on chapter 3. Let's see real fast. One of the quick and dirty. Let's see what we got. As you look at, homework's on page 138 on chapter 3. You're just basically booking some journal entries. $900 supplies have been used during the month. Well, what I'll do is I'll look at my supplies, right? I said I've got $1,900 of supplies. I've got $900 left over, so how much does that mean I've used up? Well, I've used up $1,000, right? So I'm going to have a debit to supplies expense, credit to supplies. What that's doing, that's recording the expense and of $1,000 supplies expense and reducing my supplies by $1,000. Nothing exists in accounting unless I book a journal entry for it. If it's on a scrap piece of paper, it doesn't really have any meaning. Everything that we'll do, at least for now, is going to be in a journal entry form. Utility expense incurred but not paid. So what that means, right? I've incurred the expense, right? I got to record the expense, but I haven't paid it. It's for $250. It's going to be a debit to utility expense, and we're going debit utility expense, and we're going to credit. Let's see. Probably I was thinking to an accounts payable. Yeah, of the ones we have here, traditionally in real life, you'll take it to an other payable because you don't want to mix your actual accounts payable with an accrual. But in this book, they want us to take it there. So it'd be a debit to utility expense for $250, credit to accounts payable. But keep in mind, reality, I would take it to an other payables type account. Insurance policy is for 2 years. Let's see on it. Prepaid insurance, $3,600. I'll take my $3,600 divided by 2 years, which is 24 months. Whatever that's going to be, we'll call that X for now. We're going to have a debit to insurance expense, credit to prepaid insurance for that amount. But that's just some of them in chapter 3. All right, more to come.